Welcome everyone. We had an absolutely wild week on the stock market this past week, and if anything, it revealed that we have a ton of crazy people out there. We had people that said, don't panic. We had people that said, it's time to panic, and everyone's all over the place. But what I really want to talk about today is the interest rate and the effect of the interest rate. Going back to my YouTube channel, you can see that I bought these really fancy cars, and I shouldn't really be able to afford these in my 20s, but the reason I could afford them is because, one, I've worked as a mechanic, and two, I had a pretty good salary as an engineer, and three, the interest rate effect. And so the interest rate effect is super interesting because I could buy these sports cars and then sell them for a greater value. That is, make a profit off of these sports cars. And the reasoning is simple. As the interest rate declines, consumer spending, consumer borrowing goes up, and then the value of these assets goes up as well. And so people will borrow more for homes, people will borrow more for cars, and so as a result, the demand increases for these sports cars and the value goes up. And so I could buy cars like my E90 M3, my Dodge Viper, and other cars, the S2000 CRs. Those were great profit makers, and people would take out loans to buy them because the interest rates were so low, and I would make money off of it. So it's been a free ride, essentially. I've been able to drive these really cool cars, I've been able to work on these really cool cars and make lots of really fun videos. And what did I do with the money at the time? I would just throw the money into the stock market. Even the beginning of this past year, 2017, I threw 50 grand into the Vanguard Total Index Fund. I threw $50,000 into a broad market ETF and a bond fund, and I recently sold that on Monday. And I think that was a pretty significant profit, but seeing that kind of gain in 1 year is not normal with stocks. That is just unreal. And so everyone's been accustomed to this stock market that keeps going up and up and up and up. And that's just not going to happen. That is not normal. And so it's really important to realize that that's not normal. And there are also other places to park your money. And so I want to talk about the daily Treasury yield curve rates. If we go to the Department of the Treasury website, treasury.gov, we can see the yield. The 10-year yield is often referred to as the risk-free rate. This is a comparison that analysts use when analyzing stocks. And today it's at 2.83%. That is the risk-free interest that you could earn on this investment, 2.83%. That's pretty good. And so the 6-month T-bill yield is 1.73%. That's better than a savings account. And so the yields are starting to look pretty good. So many investors might start taking their money out of stocks and putting it into fixed income investments. And I've already been doing this the past year. I also made a video about how I sold one of my Corvettes on a loan to someone. And I made a video about the loan process. And of course, someone commented and said I should throw my money into the stock market. And sure, if you like risk, then go for it, but it's very important to diversify. It's also very important to pay attention to interest rates, and that is the purpose of this video. Interest rates are very important. If you can earn a certain amount of interest risk-free, why would you take the risk of buying an asset like a stock? Why would you do that? So I think we're coming to an end of an era. I've sort of had a free ride. As a millennial, getting out of college, I've been able just to throw all my money in the stock market and watch it climb like nobody's business. And I've been able to enjoy some very nice things that I really shouldn't be able to enjoy at this age. And that's been very rewarding for me. But I think that that's coming to an end. And I really think that it's important to pay attention to interest rates. So again, to recap, the interest rate effect is this. When interest rates go down, borrowing goes up. When interest rates go up, as they are now, borrowing goes down. And this is going to have a very interesting effect on asset valuation. So that's going to be something to pay attention to going forward in 2018. Thank you guys for watching. Make sure that you enjoy your car. Also, next week, I'm going to show you how to buy a T-bill, because you might consider going to fixed income investments if you want a safe place to park your money for short term. So that is all I have for you guys. Thank you for watching. Make sure you enjoy your car.